whether it's robotics or biotech or hardware or green tech, clean tech, CPG. Yes, there are examples of those in all programs, but there's a lot of entrepreneurs who are being underserved. And so how do you create exceptional community and network? And again, going back to the core elements that I studied, how do you create that strong value? How do you create those strong cohorts? And how do you become a better investor to select the right companies that can take advantage of it?
You're listening to the Sandhill Markets podcast. I'm your host and Sandhill Markets CEO, Adam Hardy. Here at Sandhill, we focus on providing education, community, and access to venture. With this podcast, you'll get a seat at the table for discussions with other founders, investors, and innovators. I'm excited to learn a lot from these discussions, and I hope you are too.
Super excited to have you on. To put more context around this and how this came up, we've had a number of kind of emerging manager conversations. We were actually working with this a firm called Revere that does like some emerging manager, basically like grading for like institutional LPs and stuff. That kind of brought me down the rabbit hole of the emerging LPs or emerging manager stuff. And we've known each other for a while, and I know you're doing something interesting and new and maybe a little bit outside the mold of just like your normal emerging manager, which I'm super excited for everyone to learn about.
Yeah.
More importantly, though, I'd love to start just like, I know you and we've known each other for a while, but I'd love for you to introduce yourself to the audience, and then we'll get into, the investing stuff and ultimately to the program and the thing you're working on now.
Perfect. Yeah, I'd like to kind of introduce myself by saying I'm a recovering entrepreneur, because once you're an entrepreneur, you kind of can't help yourself in terms of starting new things and causing a little bit of mischief. I went to school for computer science, worked at Microsoft for a number of years on operating systems, and then started my own business. I actually bootstrapped my business for a number of years, grew it to about 100 people, sold it to a private equity company. So I had some good initial success and got into the early stage game, kind of investing and working with early stage founders. I actually ran Techstars Boston for a couple of years and kind of went through the accelerator game, trying to understand. And kind of through my journey, I've been kind of asking the question, how do you become a better investor? How do you become a better operator? How do you help founders change the world in meaningful ways? And that was kind of my early journey. Right now, I'm kind of taking some of those learnings and putting my own program together. And the goal is really, change the world in an impactful way through entrepreneurship. And so I'm kind of excited to go on that journey and having lots of fun conversations with both founders and investors.
Before we get into the where you are now, I'd love to stay on the kind of origin story a little bit more. So you bootstrapped.
Yeah. I bootstrapped for almost 11, 12 years.
Wow.
Didn't raise any outside funding, and it wasn't for lack of trying. I actually had a bunch of conversations with VCs, and they didn't understand me. I didn't understand them. I think they're at the time I was certainly younger, didn't really understand the game of venture capital. And I was like, I'm building a business. Like, isn't that what investors invest in? And so
naive.
So I was totally green. I was like, I'm just building a business. So like, I'm going to make money. Like, don't they want to make money with me? But I didn't understand kind of the mechanics of what is venture scale, what do investors actually care about? Like how I didn't understand the model. And so, I was like, okay, well, they don't want to invest in me. That's fine. I'll just go figure it out myself. And I did. We grew a really profitable business. We were doing, $14, $15 million top line, working with many Fortune 500 companies. We were in the mobile sector, so we were doing a bunch of products and services for many of the big brands. So we'd work with, Macy's and Bloomingdale's, Costco, L.L. Bean, AAA, a bunch of others as well, and had a bunch of success and a lot of painful lessons as well, as any entrepreneur probably knows.
Yeah, so you had kind of. And it reminds me of my own experience in some ways, right? Where it's like you learn about VC by like trying to raise money. like you
Yeah,
don't.
I mean,
It's like, oh, these are the guys that give you money when you want to grow your business fast, right? Like, okay, I can't get a loan, so I should probably hit up these guys.
yeah, I mean, I certainly a little bit in that way. Like as I was growing my business, we would actually get a lot of referral business from local area investors as well. So I built some early relationships, and I saw some of the companies that they were investing in. So I had a little bit of a view over the first 5-10 years. Post exit, I started to do angel investing, and it's a really great way to lose a lot of money, especially if you don't know what you're doing. So I learned a lot of expensive lessons, but through that journey, I was like, well, my goal was to help entrepreneurs. Like having been through the journey myself, I was like, it was so freaking hard and so incredibly lonely. And anyone who's ever been an entrepreneur knows how difficult and challenging it can be. And so I was like, how do I help other entrepreneurs? Like, how do I help people not make some of the same mistakes? And again, I think from an investing side, deploying capital is one aspect of it, but it's also how do you deploy value? How do you help founders de-risk their companies? And in the early days of my angel investing, I was like, let me just be helpful. Let me, what are founders asking for? I didn't really have a methodology, and I was looking to surround myself by other people who were angel investors who had been doing it for longer and more successful. And through that journey, I found, again, a lot of great angel investors, a lot of great operators, but not a lot of methodology that I could identify as kind of a repeatable, if you do this as an investor, this helps produce better returns. Now, we all know that venture capital investing is a power law business, but even as a power law business, I was like, okay, well, what are the best practices that even if it's a power law business that you can adopt either as an early stage investor or as an advisor to startups that are not like guessing and subjective, but objectively, like we know this is a good thing.
Yeah. And then so continuing on the story, so you had exited, you learned some lessons the hard way. And I think that now, as you look back on the whole experience, do you like both on the founder side and then we'll talk about how your investing has obviously matured and you've gotten more experience there. But as you look back on your experience as a founder, are you glad that you obviously it worked out, but bootstrap the way you did? Like, do you shake your head at yourself, trying to raise venture when you talk to founders, right? Because I think that that's a topic of conversation that comes up relatively regularly is bootstrap or VC. Like, is it? And what you should do, I feel like it's become more of a hot topic recently of with outcomes for venture-backed founders not always being super exciting compared to bootstrap founders. You own the whole thing, smaller outcome, more money in your pocket. Do you find yourself having that conversation or are you really working exclusively with founder, or I don't know, do you have to steer people? Do you have to be like, hey, I was in your shoes. This isn't venture. It's a good business. You should do it, but it's not venture or how do you think about that?
Yeah, I've definitely had that conversations with founders, and I don't think I think what founders need to understand is it's not a good or bad decision in either direction. I think when I was having some of these conversations, people would say, "Oh, that's a nice lifestyle business," and it was kind of used as a little bit of a jab at people. And
one of the best things VCs ever did from a branding perspective, for sure.
Yeah, it was like a little bit of that's a nice lifestyle.
You just want to make a few $1,000,000 a year, and that's all you want to do with your life. That's okay.
And I think it's a little bit unfair. I think
for sure.
Every business is a little bit different, and I think entrepreneurs need to think about capital and investors as kind of tools in their tool belt. And there are certain businesses that can effectively use capital. There are certain businesses for which capital is a poison. Like it'll actually kill your business if you take in too much capital. And it really is fundamental on some of the unit economics, some of the business, and some of the potential for growth, right? In the right hands, and in the right business model, capital can be deployed really effectively. And yes, I will take $1 million all day long because I can deploy it and turn that million into 10 very effectively. I don't need it. And that's why I say the best founders actually can utilize capital to accelerate their growth, but they don't need the capital to survive.
Yeah.
There's a great don't die, right? The key for a startup is don't die. Now, in the very early stages, you may not be able to even concentrate or work on your product because you need to pay rent, you need to eat, and you need a little bit of capital. Otherwise, you're going to go, get a day job at whatever company you're going to get a day job. But once you have a little bit of momentum, a little bit of validation, then the question is capital really effective to accelerating your growth? And it isn't always, right? Some things are slower growth businesses, and that's absolutely okay. Like, why would you dilute yourself for cash that's just going to sit in the bank and not necessarily accelerate the business and growth? There are other businesses that are like, man, it's a winner take all or winner take most, or it's you need to establish dominance quickly, otherwise someone else will. And those are great businesses to like, okay, cool. If I raise more money, I can be not just in one city, but I can be in 12 cities, and I can do it very quickly and capital efficient to dominate the industry. And there's a bunch of benefits for doing that.
Are these lessons you learned from the hard way in your angel experience, or things that you talk a little bit about, like kind of your early angel experience?
Yeah, I mean, early on as angel investor, I really, like I said, I didn't really know exactly what I was doing, and I surrounded myself. I joined maybe 5 or 6 different angel groups just to see different deal flow and different angels and how they operated. And there was a lot of different kind of styles of angel groups, so a lot of different styles of operators. I had my own spreadsheet where I tracked all the different pitches and conversations I had, and I created my own personal rubric of, does the founder have technical experience? Does the founder have market understanding? Do they have financial data knowledge? And, I tried to create a little bit of a formula on my end, and it was trying to figure out like, okay, I can build up a little bit of my own data set, but like, are there other things that other angel investors know is true that would improve the probabilities of picking winners? And what I generally found is that a lot of angel investing is super subjective, especially at the early stage. And so different people are investing different amounts. They don't have a lot of methodology. They're getting deal flow often from whether it's the networks or friends or referrals and things like that. My goal was to help founders, but I also wanted to become a better investor. And so I started to kind of dive into the data. When I joined Techstars Boston, my hypothesis was, okay, well, here's a much larger accelerator that's done, thousands of deals, has seen hundreds of thousands of companies. What is the data that I can learn to become a better investor? And what I noticed, and this seems to be true of most accelerator programs that I've come in contact with, there isn't a lot of data. It continues to be fairly subjective to the operator, the managing director of the particular fund. And I think that's okay, right? Like, and there are certainly winners, but my hypothesis from being an operator, from running my own company, is that there are knowable things about any industry, and certainly about the psychology of entrepreneurship. And so for the last year and a half, 2 years, I've been studying and reading papers and collecting my own data on what are the attributes and elements of entrepreneurship that help make entrepreneurs more successful. There's a couple of papers that are out there on, for example, immigrant entrepreneurs. That immigrant entrepreneurs tend to outperform IPOs or in public companies, unicorns that have immigrant founders on the founding team tend to be disproportionately high relative to the number of immigrants otherwise present. And so I'm like, okay, that's interesting. What is it about those types of people? And it's not about the fact that you got on an airplane. It doesn't biologically change you. It psychologically changes you. And so then I kind of dove into what are those attributes of grit and perseverance and adversity, and what are the other things that we don't even know that could be impactful to that mindset.
And, taking it forward now, so you, again, did some of your own angel investing, surround yourself with people, then got into a much even like higher volume situation with Techstars. And I think that in my own experience on the investing side also, there's a certain amount of like reps required to feel it out. And I think that what I've seen from the most from very experienced angels and investors generally, where there's definitely an art and science mix, and some people lean really far into the art side and are just like the vibe capitalists, so to speak, of like, they just have a feeling, especially in the really early stages, maybe where there's limited data. But then there's also, and what you describe, where trying to fight that a little bit and trying to quantify what is it about this founder that maybe stands out, maybe something like a feeling that you have, or something that you notice, but like, again, being more like codified about it. So you take that, again, early investor experience into Techstars, then move on from Techstars, and now that brings you to the kind of current iteration of what you're doing. And I'll bring it up because I think it's an interesting part. It's not an accelerator, and we can talk about why it's not an accelerator, but it ultimately is. It sounds like a formalization of like what you've been doing with founders, and trying to be more systematic about it. And then the term accelerator, I think, maybe gets thrown around as this like catch-all for anyone who's not just doing like random angel checks, but it's not. You described it as more of a program around, again, this experience that you've had on the investor side. Can you talk a little bit about that?
Yeah, I kind of went back to it's often referred to as first principles. Like what do we know and how do we know it? And so the term accelerator is thrown around a lot, and there's a presupposition that the elements of an accelerator are understood. And I was like, is that true? Like, do we actually know what aspects of an accelerator are actually useful to founders? And so, I interviewed every single founder that went through my programs. I interviewed a bunch of founders who've gone through YC and other programs. And I just asked the question, like, hey, you've done this program. Usually this was a couple of years post-program, so they were kind of past that initial stage. And I just asked the question, like, what of the program was useful? What of the program wasn't useful? What of the program was distracting? Why did you or didn't you do the program? Some founders have done multiple programs, and so comparing and contrasting. A lot of the things that are often associated with an accelerator program, according to founders, aren't particularly useful. And so there are a number of things that are useful. And so I tried to separate them. That's why I'm like, when I refer to the program that I'm putting together, the word accelerator may not be the right word. The thing that I have generally observed and kind of consistently heard is camaraderie and network is important, incredibly important to founders. And so the entrepreneur journey is incredibly lonely. The aspect of working with other founders to bounce ideas off, to share resources, connections to investors, give feedback to one another on whether it's pitch deck, financial model, or customer introductions, those are uniformly valuable. Network is really valuable as well. And so again, this is very subjective based on the quality of the network. Some folks call it mentors or partners or other people in the network, service providers. If that network is very strong, then the signal to noise ratio is really good. Most of the people you reach out in the network are super positive and engaged. If the network connections are loose, you reach out to the people who are in the network and you get noise. You're not getting the value that you're expecting. And so strong network is really important. From the investor side, a cohort mentality, when you're investing as a group, there's actually a lot of benefits for the investor side because you're not negotiating each individual deal term. You have more of a standardized deal. And so founders don't feel like they need to negotiate, and they don't feel like they're getting screwed. They're not saying, I'm getting a good deal or a bad deal. They're getting a fair deal for the stage that you're in. And if you want the deal, it's a fair deal. And if you don't want the deal, that's okay too. But that reduces negotiation on the deal terms, and it can actually improve the investment economics for the investor as well, provided they can deliver on the value. And so that's kind of a lot of the things that we were sharing. In talking to a bunch of founders and doing research on this, most successful, like highly successful founders, and I would kind of attribute it like several $100 million or $1 billion exits, they tend to be exiting in their 40s. And so if you back that up, because it sometimes takes 8 to 10 years, it means they're starting their companies in their late 30s. Most traditional accelerator programs are really targeted for a younger audience. And so come to a different city, focus, code all day, code all night, like build your product. That is cool for a certain audience. But if you are a mom with kids that are in school, like it's going to be very difficult. Now, my belief is that, and there's also research to support this, that women are incredible investments. They return more on a per dollar basis. They're more capital efficient. But a lot of these early stage programs aren't necessarily set up for them. And so we're like, how do you get cohort? How do you provide the flexibility? And so we leaned into what I would call more of a cohort-based program where we are bringing founders together. We have a uniform deal, but we are remote first. We do think that there's elements of bring people together as well. We actually did last year what we called an anti-demo day. Because again, going back to first principles, we observed most demo days are not actually about demos.
Yeah.
And the promise made to founders is that you're going to get a check.
Mm-hmm.
And the reality is that, other than YC, and YC is very successful at this, most accelerator demo days don't involve kind of companies getting fully funded. And so from the investor side, investors are first meeting these companies. And so we called it an anti-demo day, and we didn't put it at the end of the program. We put it in the middle of the program. And the idea was like, we want investors and founders to meet each other because it's really about relationship, and investors invest in lines, not dots. And so if you're just meeting a company on demo day, you don't see a line, you see a dot. You're like, this is what they are at demo day, and I may or may not engage. And so by introducing founders and investors in the middle of the program, we say, hey, we want to introduce you. There's no expectation that you're going to invest at this point. That would be ridiculous. But you can track this company over the next 2-3 months. And when they are ready to fundraise, you'll have formed a relationship and seen a better indication of that line.
Yeah, no, all super interesting. And I think that it's conversations that we have a lot because I've invested in YC over the course of the last 2 years, probably where I've done the most of my investing. And I think that you're absolutely right about a couple of things that you mentioned where it does gear younger. It's a kind of, and it reminds me of friends that were thinking about going to business school where there's not an age limit, but there's an age that kind of makes sense. Like there's an age where you look around and you're like, oh, everyone's kind of the same age as me. And then there's an age where it's like, oh, I'm definitely outside of the bell curve or like, on the fringe. And that makes a lot of sense. But I actually have a question about that. And then on the anti-demo day side of it, you're absolutely right. We just did the in-person event with Y Combinator. They hosted a lot of the investors who are, the most active investors in YC. And I went out to California to meet people in person. But the vibe is so like, you gotta do something. Like, what's gonna happen? Like, it's you're not getting to know people. Yep. You're trying to make investment decisions, and like that's a different thing, and not super productive. I actually think that YC may be following your and coming to similar conclusions. Where I've heard rumors that they will kind of move it up actually because of that exact kind of comment, right? Where it's not a time to meet people.
Yep.
But some questions in terms of actually bringing together the cohort, because you mentioned the later, like a little bit, the older compared to like a YC, people who are more experienced, and the data supports, let's say it's, mid 30s entrepreneur or early 30s entrepreneur, whatever it might be. I think it's probably mid 30s based on the number that you just shared.
30s or later. Like again, there are plenty. I think the older founder is often overlooked, and the data doesn't support that. And so again, I've invested in young founders who are just MIT grad, like hustling and super smart. And again, there's going to be winners there. But looking at the data, you want to create, like in my opinion, you want to architect a program that's inclusive of both sides.
Yeah. So you're not necessarily dismissing younger founders.
No, not at all. Not at all. We're trying to be objective with the data, and I can talk a little more about this. But we developed our own what we call a founder index, where we ask a number of questions around the psychology of a founder. We don't ask age because we don't want to be biased or by age, but we do want to make sure that we architect the program such that it is inclusive of people who want to do that, right? Like, and so
it's
if I
not
said,
like you have to leave your family for 3 months and live in San Francisco to be a part of the it's more
yeah,
about opening up the requirements in a way that you can fit that founder in.
that's exactly right.
Got
That's
it.
exactly
Got
right.
it.
And there's some great programs that are like a lot of respect for a number of programs. Like I think HF0 is doing a residency program.
Yeah.
YC is doing a bunch of awesome stuff. It's just, and it fits some founders. Some founders will really appreciate that. But there are going to be a number of founders who are like, I have family, I have obligations, I have other commitments to where I am. And from a geography standpoint, I say founders should go and be where their customers, their investors, and employees are, and that's it. And sometimes those are in a particular location, and sometimes they're somewhere else. And so you need to create the flexibility for the founders to actually run their company, not be distracted by an accelerator.
And then, so in terms of, and these are some of the hard questions I think around these sorts of programs, especially as a up and coming program, where there's a certain amount of like YC is YC because YC is YC, right? There's almost like a circular logic to
Sure,
like
yeah.
why they continue to be who they are, and then there's for accelerators outside of it, or programs, and as people are kind of Neo is another example of like someone who's come into the market and like a kind of louder like go here instead, it's better. When you think about the type of founder that would come to your program, like, do you think of yourself as competing against other programs or as being just a separate offering that fits a different type of founder better? Like, how do you think about like a founder that has, all the options in front of them, from YC to your program to just raising money separately and not having to go through a program? How do you kind of think about a founder that's making that decision, or is that not kind of how you think that you approach
I've
it?
certainly been in competitive deals, and I tell founders that they should really lean into the things that are best for their company and their business. And I don't think it's a one size fits all. I think my background and experience, and Jess, my partner in the fund, her background and experience are going to be really great fits for certain types of founders. And to your point, like Near or YC or other programs may be really good fits for other founders. You kind of have to, like, at the end of the day, and this is true not just of early stage programs, but certainly of Series C to Series A and later stage, like you have to choose investors who are going to be good fits for you, folks who founders want to work with on a regular basis. You want, like, there's, as I said, there's two aspects to every investment. There's deploying capital and deploying value. And for the founders as well, you are getting capital and getting value. And so founders who are being transactional and purely making decisions on what's the highest cap, they may get the equity value, but you want to make sure you're kind of hiring an investor to be on your cap table to help grow your business. And so from that perspective, is it competitive? Like, yes, a little bit, but I also don't want to have founders work with me who don't like me or who don't think I can bring value.
Yeah. Interesting. And I think that actually leads me to my next question about scale and about the ambitions that you have around it. Because I think that the thing that is so, like, YC is so different than what it started as. And it has lost some things that it had, and a lot of the things that it had in the early days, but it's gained other ones, right? Where the network has gotten bigger, the brand has gotten bigger, things like that. And I think that when I see programs like yours, there's a certain advantage that you have by a lack of scale, right? By being smaller. But I think what often becomes the kind of follow-up question to that is that, do you plan to stay there? Like, do you think of this as a kind of artisanal offering that you will like keep small and keep about you and your partner, and it's you all kind of you two bringing your expertise to a cohort? Or do you have ambitions of standardizing to grow, or standardize, maybe to grow the cohort, maybe to grow the network, whatever it might be? How do you think about today versus multiple cohorts down the line?
And it's probably useful to kind of understand the macro level goal. Like when I exited my company and I started to give back to entrepreneurs, the question I asked is how can I leverage my time, resources, and money to make the most positive impact on the world? And I do believe that entrepreneurs are the best people to shape the world and create the change that we want in the future. From that perspective, I do think it's critically important that we are delivering a superb amount of value and a superb amount of investment returns to our investors because that gives us the opportunity to create further change. And so from that perspective, I do want to increase the amount of impact that we can have in the program. So from that perspective, I do want to grow and be able to impact more companies, but I don't want to dilute the value. Like one of the things I've definitely seen in certain programs as it moves to spray and pray. Let's just make a lot of investments. Let's make a lot of deployment. And in my opinion, this isn't super high value. Like, I mean, it's again, you're delivering on the equity cash value. You're giving people money, but you're not going to deliver the true impactful value to grow their business. And it becomes more difficult to do that as an investor. I think in particular, now specifically in 2024 is one of the best times to be both an investor and entrepreneur. I think we're at a transformational moment in history. I do think in general, there are a ton of amazing entrepreneurs, and many of the other programs have reached a scale plateau that's difficult to go beyond. And so I think YC is, and you brought them up a couple times, has done an incredible job, and it's a great fit for certain types of companies. But there are other entrepreneurs who are like, we don't fit that mold.
Yeah, there's more than 250, or there's more than like 500 entrepreneurs a year that are interesting
and there's a bunch of industries that are underserved, right? Like if you are, whether it's robotics or biotech or hardware or green tech, clean tech, CPG, yes, there are examples of those in all programs, but there's a lot of entrepreneurs who are being underserved. And so how do you create exceptional community and network? And again, going back to the core elements that I studied, how do you create that strong value? How do you create those strong cohorts? And how do you become a better investor to select the right companies that can take advantage of it? And so, again, intention is not to let's just scale for the sake of scale. It's really, how do we effectively scale without diluting the value? How do we incentivize? And I actually think when you create more of a partner program, it creates those long-term incentives. Like that's one of the other reasons I don't call ourselves an accelerator, because accelerators don't necessarily think of it as partners. And that's the way I'm trying to think through our program. Like as we think about scale and potentially helping more founders, I want people to think of us as an investor first. We're an investor first. We have to be a great investor, and we happen to invest using the cohort model.
Got it. Interesting. And I think that you're absolutely right about there being an underserved aspect, of the market. And I think that, YC has grown a lot, but has always been very B2B SaaS focused. They're starting to move away from that a bit, but they're continue to be, I can't remember the last time I saw like a CPG brand in there, or there's some biotech. But anyways, there's the main point being that ecosystem has grown faster than they've scaled, or the founder ecosystem has grown, and that creates opportunity. And ultimately too, like it goes back to the point you made about the fit, founder investor fit, kind of like choosing a partner, choosing the right program, being thoughtful. And in some ways, I think it could serve you positively that a founder who is being that like thoughtful about partnership won't be as allured or as kind of like shiny YC branding, because that's a big part of it too, right? There's a lot of founders that just take the YC brand because great, it's just another. It almost has become. It almost in some ways has become like the same kind of path that university systems have taken, right? Where the Ivy League diploma is more of a branding exercise than necessarily like a hard skills in a lot of cases.
That's actually a great analogy, and they are the Stanford. And my belief is that we have room in this world for MITs and Harvard as well.
Yeah. No, absolutely. And I've used that with people as well. And I think you're absolutely right. So as you kind of look to the, in the current phase of what are you working on within the program today? You've run cohorts already?
We ran a
What's
test
going on?
cohort last year just to prove the model and kind of get a little bit of quantitative analysis on. We basically set out to prove three things. One, that we could attract founders without the brand name because we were brand new. Two, we could deliver value at very economical rates. Basically, we wanted to make sure that we can operate as a investor first using kind of the traditional fund mechanics as opposed to being funded through corporate programs.
Yeah.
And then three, we wanted to make sure that we're able to deliver value both to founders and investors. And so kind of across those three, we're kind of like, how do we make sure we de-risk these before we raise a fund? And so, our journey now is to scale up what we did last year and impact a lot more companies in the coming year.
When you look back on that test cohort and you look towards your, let's call it and how many cohorts are you planning to run a year?
We're going to do 2 a year, a summer and a winter, with 10 companies per cohort.
Got it. And when you think about the test cohort and the number of cohorts that it'll take to, I'm thinking about this, the founder hat on, that I know that you the way that you think about it of what are the metrics or the early sign? Because the reality is that the timeline of did it work is 8 to 10 years.
Yeah.
In terms of the real, return on capital, the real money in investors' pockets. And there's a certain aspect and whatever. The best time to start a journey like that is yesterday type of a thing. So you need to get going to go down that path. But in terms of early signs of it working and early things that you're tracking to understand the test cohort, to understand these cohorts coming up, and to be able to say, now or in a year from now, it works, see numbers X, Y, and Z. What are those I don't know if KPI is the right word, but what are the metrics that you're tracking in the shorter term that you think, start to draw that line towards where you ultimately want to go?
Yeah, again, the test was to figure out, can we attract competitive companies? And of the companies that we got, a number of them got offers from Techstars. We also evaluate, and a number of them have been through other accelerators. So we asked them subjective questions like, hey, are we delivering on the value per equity, and kind of what's, on a scale of 1 to 10, or how do we compare? And we're trying to be objective about the value delivered, value received, to make sure that we are delivering value to founders. If we felt we weren't delivering adequate value to founders, we wouldn't be going forward to the next step. We'd be iterating on how do we reframe the program? How do we do this a little bit differently? I do think long term, we are an investor first. And so the long-term KPI is DPI, right? Can we distribute capital to the investors? Because that gives us the ability to, have larger funds and help more founders. So that's ultimately the long-term, either IRR, can we produce returns for investors? Can we produce distributions for investors? In the short term, it's kind of, can we attract the right founders? Can we deliver the right value to the founders? Can we deliver the right value to investors in terms of filtering? And again, the reaction from our anti-demo day, we had about 120 investors across Boston, San Francisco, and New York come to our events, and they were like, yeah, these are really good companies. And again, that's the filter for short-term KPIs, but the long-term KPIs, investment returns.
One thing though to harp there is, you brought it up before, and kind of one of the cardinal rules of startups being to not die. And I think that one of the things that YC has, gamed in a lot of ways, and done a good job of it, is that when founders, basically, I can't think of a YC, or I guess there are some that can't raise after, but mostly, right, you do the cohort and you have a really as good of better than average shot at raising. And there's a lot of people, right, that don't think as deeply around these types of programs, and that thinks to themselves okay, I'm running my business, I'm going to do this program and they're going to like get me to the next, they're going to get me to my seed, or they're going to like allow me to raise my seed. Do you think about graduation rates in the short term? And when you like, do you think about, and obviously, you know, graduation rates, like all it takes is one, and, you know, it's a power law business and all of that. But in the shorter term, right, like if the companies don't survive in the first iteration, then there's no chance of them, you know, making it further. How do you think about like target, or do you think about target graduation rates being like, the program and then you raise money? Like, are you thinking about companies raising money at the end of the program? Are you thinking of it differently than that? Are you thinking about, you know, goal metrics from a, you know, graduation from C to Series A in a year and a half, or is that all,
so
kind of further down the line?
We modeled our our financial model is really baked into both, we'll call it certainly graduation, or kind of whatever the next step is from pre-seed to seed, from seed to Series A. Across that, we've modeled in kind of historical numbers based on Carta. Has kind of like, what is the typical number of companies, mortality rate, companies that don't make it, and companies that graduate, and then companies that have an early exit. And so long term, we want to be better than the Carta norm, because Carta's looking across a bunch of companies. I do think that early funding is, you know, and certainly some of the things that YC is able to do is really the power of the network, right? They're able to attract more investors. They're able to generate more of that FOMO. My goal is to get there, right? Like, I don't expect that 1,000 people will mob my anti-demo day in years 1 or 2. But again, if we can start to have good outliers and good success in history, people will pay attention. And that's up to, you know, us as investors to be thoughtful. Again, in the test cohort, I was deploying my own capital, writing relatively smaller checks. And the reality is that my smaller check isn't going to give a company, you know, 12 to 18 months of runway. If we're deploying a couple $100K into a company and it's a small 1-2 person team, like, they should be able to survive for 6 months or a year, or potentially longer, if they're, pulling in the belt and saying, like, how do we run, operate, and generate early revenue? And so it often, just based on my prior cohorts, it often does take, you know, anywhere from 6 months to a year to kind of get to enough momentum, enough relationships to close that seed. And, you know, again, knock on wood, but feeling pretty optimistic.
Yeah, great. No, so I guess the answer being that, and I think that, again, like, everyone gets kind of skewed by the YC, like, and we've talked about this a lot at Stonks and at Sandhill, and like what's typical. And I know you've experienced it at Techstars as well, where like it's very much an outlaw. Like, these companies that come out of, you know, that pivot, like, you know, 2 months into YC and then raise a seed, is not the way like the world works, really, and oftentimes it really often shouldn't be. And so I guess to regurgitate a little bit in terms of like what the answer being that, like, you put a little bit of your own money in. Those companies are still, like, the first cohort is kind of still actively in the process. But then ultimately it's about improving on that model and showing, and I think the reality too of like growing the network, which we're excited to help and to be a part of that, and bringing some of our LPs and our investors to see it. One, just because having a thoughtful person running a demo day is good value, period. Like, we've done that. One of our core insights on all of that has been that, you know, you just having someone curate the ecosystem is just a hugely valuable thing from an investor. You know, you don't have to do the work, right? You're doing the work to bring that group together. But that it only takes like the promise of one, or the promise of like you know, you can show up to a demo day knowing if there's 10 companies in it and one of them turned out to be a really exciting company right from the first test cohort. That's all it takes, actually, from it's worth your time, right? Because that's even very dense, right? Like, it doesn't.
That was exactly the question that we asked our investors, right? And many of the investors who attended have taken meetings with 2, 3, or 4 of the companies, not because they felt any obligation to me, but they genuinely showed an interest in those companies. Now, the reality of whether that particular investor invests or not, you know, I would say it's a shots on goal problem for founders. They have to kind of fine tune their story and their message and have enough of those high value conversations where they kind of have that founder investor fit and they feel like, hey, we can help each other to grow the business.
Yeah. Well, I know we're coming up on time here, but I'm super excited about it. And again, I mentioned like we're excited to bring this kind of thoughtful curation to our investors. Like I talk a lot about, good emails to send, like, and ultimately that being a big part of what, gets shared from a deal flow perspective, and that just purely the amount of thoughtfulness that's going into the cohort from your side and from your partner side is, I think, puts it into the worth looking at category, right? Because and the thing that's interesting about demo days is they're a pretty low ask. If you're an active angel investor or a fund or someone who deploys capital professionally, and someone says, I took in a ton of applications, I've worked with these founders for a period of time, I think they're the real deal for X, Y, and Z reasons, show up, learn about them for an hour or whatever amount of time it is, and if you're interested in them, press the button or ask for an intro or whatever. It's very high ROI. From an investor perspective.
We actually even went beyond that for our anti-demo day, because what we found, and I've done a lot of both online demo days with stonks, and I've done in-person demo days. Having investors sit for an hour and a half, like if you walk the room, people are checking Twitter. They're like, it is not easy to do. And so we structured it very, very differently. We really compressed. Again, we have 10 companies that kind of want to introduce themselves, and it is meant to be an introduction, not a pitch. And so there are really no course slides. And so we ask each founder to just give a 3-minute introduction on who they are. That is all very rapid pace. So in half an hour, it's done. And then we dedicate all of the time to conversations. Right? It's a highly curated room. And so the more conversations you have, the deeper conversations you have, the more engagement you have. And so rather than light engagement for an hour and a half, we're like light introduction, heavy engagement. And trying to make it even easier for people to really lean in and have the conversations that they want. If they don't want to have conversations, they're in for half an hour and they can go, process email or check Twitter or whatever they want to do.
Yeah. Well, cool. Again, I'm super excited about it. We'll it's not the last that the Sandhill kind of audience will be hearing from you, and hopefully it's really just the beginning. So excited to get this wrapped up, and we'll see you out there.
Awesome, Adam. Thank you so much for the time.
Yeah, thank you.
Thank you for listening to the Sandhill Markets podcast. If you enjoyed this discussion, make sure to click the link in the description to subscribe to our newsletter. You'll be kept up to date on venture news and our weekly live events where we host similar discussions with other amazing guests. You can also follow us on LinkedIn and Twitter, where we post regularly about upcoming events. Once again, thank you for listening, and talk soon.